All right, let's start. Do you have any question? All right, so today we will discuss the last chapter of the course, which is interest rate model. Okay, and so first we want to discuss something, right, about interest rate in general. So far, right, we assume interest rate is a constant, right? Or that is not true in general, right? In reality, right? So in practice, right? And also one more thing is that we also assume that the discount rate, the compounding is done continuously. Okay, so neither of these has to be true in reality. These are just basically some approximation to make our model easier to handle, right? When we focus on option pricing. But when you focus on the interest rate itself, then neither one of these is true. And actually, so how should we define interest rate, right? So in practice, right, there is, right, there is not a single, right, entity. There's not one single entity, right, or maybe one unique entity that can represent the risk-free rate. There are many candidates for this guy. For example, the overnight short rate, of the Fed, of the US Fed, is one of them. But recently, other kind of quantities that can also be considered, such as the LIBOR rate, the LIBOR swap rate, is another. Okay, and we don't have to get into it, but basically the point is that even to pin down, right, what we think of as the little r in reality can be tricky. All right, and there's like the whole discussion on what this is in practice, what kind of quantity or what kind of measure out there that we think of as the risk-free rate. So, but anything like this, right? One thing either way, right? Whatever we pick, we notice, right? Whichever one we pick, we note, right, that two things. A, they are not constant in time. So in other words, right, the interest rate change with respect to time. So R is a function of T, right? Some of them are discrete and some of them are continuous. Some of them are discrete, compounding. In other words, what happens is that, say, the LIBOR swap rate here, right? You enter the rate for like a duration of, let's say, a week or a month. right? And you get the rate fixed for that duration, for that whole period. So let's say the LIBOR swap rate for, let's say, 1 month, 3 month, etc. Right? And some of them are continuous compounding. For example, right, the overnight short rate of the Fed. So approximately, okay, continuous compounding, which is the overnight short rate. Well, approximately because, overnight, this rate is applied only for the lending and borrowing for 1 day, right, for 1 night. And so 1 night is quite short duration, and we kind of could, right, we could consider like the approximation as continuous, but right, I mean, like truly continuous compounding is kind of hard to find out there to begin with. But right, so but the point is that, right, they're not constant in time. And finally, you can observe that they are, right, random, in the sense that they are subject to the fluctuation of the market, right? Subject to market shocks, right? Unpredictable, that kind of thing. Okay. So basically, all in all this observation tells us that the risk-free rate, right, the short rate, should be modeled as a stochastic process. Okay. And the fact that some of them are discrete compounding, right? Say you have the rate and you lock it in for 1 month, 3 month, that kind of thing, lends itself to a discrete time model. So both discrete time and continuous time model are appropriate. In the sense that, right, I mean, with stock price, we see that discrete time model, like the binomial tree, seems a little bit artificial, right? It's just like an approximation. It's the first thing we look at to make it easy. On the other hand, for interest rate model, right, short rate model, discrete time seems like a natural right setting sometimes, because the point is, right, that you have discrete compounding to begin with, right? You lock in that rate for that duration. And continuous time is probably, right, more like kind of at home with the continuous compounding, of course, but we can also discuss, right, discrete compounding in continuous time setup as well, right? So the plan, right, for discussing this materials is the following. So the overall plan, right? So one, we discuss short rate, interest rate, model in discrete time setup. And that would be the binomial tree. Okay. And we'll discuss 2 models, the Holy model and Vasicek model. So the model, interest rate model, in continuous time setup, and that would be the Vasicek and CIR model. And then, right, so these are just models. Then the whole point, right, of this class is basically pricing, okay, based on the models. So what kind of pricing do we want to discuss? So pricing, right, here with interest rate has two kind of separate products that we want to pay attention to. The first, and I guess the most intimate product that is connected with these guys is the bond, zero coupon bond. Okay. And so zero coupon bond, I guess everyone knows what it is about, right? So let's say we denote something like B, right, with capital T as the maturity time or expiration, and little t is the current time, right? Is the price of the bond, right, with maturity time t, and let's say face value 1. Okay, so that means, right, that the holder of the bond by time big T can come and claim, right, receive $1, right, from the seller, which could be the US government or someone like that. So before, right, to decide this price is a very simple thing, right? We do e to the minus r t minus t. Okay, that's it. So this, right, like I said before, has the kind of drawback that they do not capture, right, the randomness of the interest rate or the fact that the interest rate as a function of time, right? Because here you imply two things, right? The fact that you say that this bond price at this future time, right? Notice that the kind of like right now, right, is time 0. So this is the future time. You say that in the future, you know what the bond price is exactly. So you are really implying, right, that everything is deterministic as far as the bond market is concerned. That clearly is not true, right? So here, right, you by this formula, you say that R is deterministic. But more than that, right? So you say this is deterministic, which is definitely not realistic if we want to zoom into that aspect. The other thing is that, right, you say that the R, right, on the interval from t to big T does not change in terms of time. Right, let me just say does not change. Right. So which is not true either, right? Which is strange because basically this is short rate. From this time window from little t to big T, you would expect the short rate would change. So these two factors, right, will need to be modified. But then the question is then if suppose we have a model, right, for R of t. You know, and for now, let's just quote, let's say the Vasicek model. Let's say Vasicek, right? Then, which means that the rate, right, the interest rate move like there's a level, right, my RT with a factor of return dt plus sigma dw tilde t, like this. Okay, then how does this relate back to the bond price? And that's right. That's the one thing about the pricing equation. We want to price the bond given, right, that we have an interest rate model. Okay. Now, so we want to, right, write BTT in terms of, let's say R, okay? I'll put it like that, but technically speaking, is the R from these two. So because the behavior of the interest rate from time little t to time big T will decide the discounting factor you get to get back to the bond price. Now, as with everything we do in this class, right, we kind of do things in the opposite of what the market really says. In reality, right, in practice, right, what you know is the BTT from the market price. We know the bond price. By observing the market. Okay. So one very simple observation that will be used kind of, casually sometimes in this class is that BTT then can be used as a discount factor or as the discount factor for the time period from little t to big T. In other words, right, that K dollars, right, at time T will be worth BTT times K at time little t. Is that okay? So that's the discount factor. So in other words, before, right, when we say something like this, where was it? What we're saying, right, is $1, right? $1 or K dollars doesn't matter, right? At time T will be translated back to e to minus R T minus T dollars at time little t. But this is artificial. Okay, this is artificial. In other words, we just pretend that there's some unit like that we can use to make a discount of. In reality, right, what we have, or what if you really want to look at, is exactly just this bond price, right? Of course, sometimes you have to pay attention to face value, right? Bond price in reality doesn't have face value 1. It may have face value $100,000 or something, right? Or at least $1,000. So you want to divide, right, the bond price with the face value to get the correct translation. But if the face value is $1, then the bond price exactly, okay, by the market gives you the discount factor. So even, right, when we formulate the model for the interest rate model, these are fictitious. In other words, this is our model for the interest rate. By observing the bond price in the market, we will calibrate it with the pricing equation to figure out what we can say about the behavior of the interest rate. All right, interest rate is the harder thing to observe. Bond price, always available in the market, right? I mean, like you should be careful. This is not corporate bond, because remember from the Merton section, right? Corporate bond has a risk of default. So the yield, right? The yield of the bond is not exactly risk-free. So they have to compensate. They have to give the holder a higher yield because they may have default chance. This kind of bond is like, non-defaultable bond, which, could be like the US government bond, for example. But anyway, you can observe those kind of bonds in the market. And then right from there, you connect back to the pricing equation, because that basically the pricing equation tells us how the bond price can be obtained from the interest rate. And then from there, right, you can deduce the behavior on the interest rate itself. Okay, but in class, right, we do the opposite. We pose the model, we tell you the pricing equation, right? But in practice, you go backward. Any question on this? Right, so the bond pricing is the first fundamental thing we talk about, which is very easy. Once you write down the equation, right, then the model for the interest rate, the bond price just comes out. Question on this? All right, so then the second thing that we talk about is so bond, right? Technically speaking, is pricing, but that's not like the kind of pricing that we really are concerned with in interest rate. The pricing that we're really interested in is called the interest rate derivative. Right, and it comes in three flavor: the cap, the floor, and the forward. So you may see that actually these are the exact analog of the option on the stock. The cap is like the call option. The floor is like the put option, and forward is exactly like forward contract. Okay, so what's the story, right? And let's just describe this product, right? We'll go back and fill in the details. Basically, imagine you have a period like this, t to big T, okay? Right now it's time 0. Suppose that you know that you have to borrow or lend at this moment, okay? And then you need to be pay back. So for whatever purpose that you're entering in, basically kind of borrow or lend cash, right? So you want to participate in the money market at this time, right? Borrow or lend. And of course, right, from the point of view of time 0, you do not know what rate you will have access to at this time. Because, right, if you borrow or lend at time little t, you will access the market at that time, so you will have to accept whatever rate that they give you at that time. So, of course, you know, for your protection, what you would like, right? So what you would like, right? Let's say you would like a rate, let's say K, okay? I don't know, K is like 3%, 2%, whatever, right? So of course, right, the rate at time little t is not going to be like that. So what happens, right, is that you can lock in either a cap, a floor, or forward. That would, right, so basically a cap, right, roughly speaking pays, you know, interest rate R minus K plus times the time period at time t. Okay, so this is the difference in the interest that you would have paid if the interest rate is above K. So you enter a cap, so the cap pays you this much. So here, right, this is your protection for being worried that the interest rate goes above the level K, okay, during this time period. And the floor, right, does exactly the opposite. So this cap, right, protects for in the case R, right, is bigger than K during the period T to T, okay? So by R here, I don't mean a single R, all right? So by R here, I mean the rate available at time T, okay? So we'll be more precise. But this R is not a constant R, but think of it as like a discrete rate that gives you the lending or borrowing rate you have access to, right? Think of it like you buy a house in the future, in a year from now. This is the rate that they will allow you to borrow, you know, your mortgage at that time, okay? So the floor will pay you the opposite. Okay, and it protects, you know, in case R less than K on TT. And the forward, so the forward actually is different, okay? I know there's a forward contract in stock, right? In the stock derivative that we talk about. Here actually is more like a forward rate, which is exactly like a forward price that we talk about, you know, in the forward contract, right? Forward price is a strike. So forward rate is exactly actually a rate K0 that we can agree right now, we can agree on at time 0 for borrowing, lending at time period, at time t, without paying anything, right? Okay. To enter the contract. Is that okay? So obviously, right, when you want to buy a cap or a floor, you will have to pay something because, right, it pays you a non-negative amount, right? It pays you a non-negative amount at time big T. As long as, right, the condition is fulfilled, it'll pay you something. So for that reason, right, it will, the price is times 0 of either cap or floor, right? It's like put or call, cannot be 0. On the other hand, right, the forward rate is not like, so you don't get to choose this level K, okay? It's a rate K0 that someone will tell you, okay, you can lend or borrow at this rate. But if you agree, that's going to be a fixed rate. It's not going to be random, right? You will know you have access to this rate right now for lending or borrowing on this time period, and it costs you nothing to enter. It may not be a rate that you like, but you get it right now. It's a fair rate that's guaranteed to you, right, for borrowing or lending in the future. So again, right, the task is given a model, right, given an interest rate model, how do we, price the interest rate cap, interest rate floor, and how do we figure out the forward rate? Question on this? Okay. So now then let's start with the discrete interest rate model. Okay. Now, so first, right, what do we build the model upon? We want, so let's say we have, for simplicity, let's say we have 0, 1, 2, right? 2 periods, okay? Then at time 0, right, the interest rate is fixed, it's called R0. Then how do we want to model, right? The interest rate at time 1, interest rate at time 2. We want it to change, right, with time. We don't want it to stay fixed because it's a function of time. Also, we want it to be random. So a simple yet a bit naive way to do this is, just copy what we did, right, for stock, right, the stock model. Like that. So this, right, fulfills two things. It makes the model not a constant function of time, and is, also a random variable. On the other hand, right, when we do a model, we must be mindful of the content of the model. Does it capture, right, some qualitative, right, behavior we see in reality? So with this model, do you think it's okay? Any issue or anything you would worry about this model compared to what you know about interest rate in reality? So, right, basically using this model obviously has the implication that interest rate and stock behaves in the same way, which actually is definitely not true, right? interest rate and stock do not behave in the same way. They are two different, very different processes with different qualitative behavior. So remember, right, what is the basis for having the U and D in this case like this, right? So let me say this, right? This is not appropriate for interest rate model. Because basically the intuition does not apply, okay? So first, right, the U and D, they model the return over one period of a stock, right? Because I mean, if you take something like this, like S1, right, minus S0 over S0, this is a percentage return over one period, then you can say, right, this is going to be either, right, it's going to be S1 over S0 minus 1, so either U minus 1 or D minus 1. So that's the percentage return, right? You say the percentage return is either U minus 1 or D minus 1. Return is not a concept that applies to interest rate, right? Because interest rate is return itself, right? Interest rate is actually your return for investing, right, over a period of time onto the money market. So there's no such thing, or actually the concept of return is weird, right? So that's one critique. Another one, which is a little bit easier to say, is this, that with interest rate, what we want, right, what we want in any interest rate model is the phenomenon called mean reverting. Mean reversion, okay? So what does that mean? What that means is when we observe, right, stock, let's take Amazon, right? You see it's such a good stock, it keeps going up, right? I mean, of course it does go down, but the general trend is just keep going up, right? Take another company, but that's like doing not very well, they just keep going down, right? Interest rates not like that. It could go up for a little bit, but then it will go down, right? It could go down a little bit, then go up. There's a stable level, right, that the interest rate tends to hover around, right? For one thing, I mean, it's regulated, right, by the Fed or by someone like that. Or second, right, I mean, it's just, right, unless you have something go very wrong with the market, again, right, the cost of lending or borrowing over a period of time tends to stabilize over a long term, right? And that, by the way, right, is expressed right here in the Vasicek model, right? We discussed this a little bit, I think, when we talked about how to understand, right, the dynamics of a, Ito process, right? When RT is bigger than mu, this term is negative, so it pulls it down. When RT is below mu, this term is positive, so it pulls it up. So the overall effect is that, right, if you have a mu level, then RT will tend to return to mu in the long run. Okay, so having this model like this, however small U is, right, and however small these probabilities are, what you're saying is there is a chance that the interest rate just keep going up, right? And there's a chance the interest rate will keep going down with no mean reversion. And so that, right, is not desirable. Is that okay? So on the other hand, right, mean reversion is easier to be incorporated into the continuous time model because, there's a dynamics there with the Brownian motion and that kind of thing. In discrete time model, it's harder to force the mean reversion explicitly onto the tree. Okay, so what's the idea? Okay, so let me say this, right? This is easier to achieve with Ito process in continuous time model. In other words, what I'm trying to say is just the structure of DRT, the change in interest rate equal to something, right? Makes it easier for us to control it. It's positive if it's above mu, negative is below mu. Notice that kind of like the structure of here we want is a product structure. I mean, if that's all we're thinking about, it makes it harder to do this, okay? So in all then, right, in the discrete time, the common technique or the common right way that people go about doing this is the following, right? So basically you give up, not give up, but you relax on the idea of mean reversion, and the idea is we're gonna model, right, the interest rate with flexibilities, right, based on the up and downs of the based on the ups and downs of the binomial tree, but with flexibility on the actual value of the interest rate. Okay, you see what I mean by this. Let me demonstrate to you what I mean by non-flexibility. So basically what we want to say is we still want, right, this tree to give us some idea about randomness, because actually speaking, right, here you see that up doesn't have to be rigidly interpreted as an up movement of something. Up is just like a coin flip that lands on the head. D is just a coin flip that lands on the tail, right? So we want this to give us some fluctuation in terms of modeling the randomness. But if we don't want to tie the actual value of the interest rate to be to the up. So it's like if a coin flips head, our interest rates have to go up by a factor u, right? There are other ways to do so. And that's what we mean by flexibility, okay? And so I will give you the two models on Vasicek and CIR. I'll write them down. Oh, sorry, Vasicek and Holy, okay? I'll write them down and I'll explain to you what they mean, okay? Any questions so far? So let's see here. So for the whole lead, it says this: R of K, right? K is the time K of the event omega will be AK plus BK times UK of omega. And the Vasicek model says, let me see here. Oh, sorry. I apologize. I said it wrong all this time. It's not Vasicek. Vasicek is a continuous time model. The discrete time model has a different name. It's called Black-Derman-Toy. I'll correct it up there, okay? Black-Derman-Toy model. And it says this: RK of omega is AK BK raised to UK omega. So let me correct up here and then I'll explain. Holy and Black-Derman-Toy. Okay. So what is this? So remember, right, omega stands for the sequence of U and D. Let's say, you know, omega could be for us, right, UU, DD, UD, whatever, right? It's a sequence of UD on the tree. That get us to where we are at. So UK of omega basically counts number of U's in the sequence of omega. All right. So exactly, this right here says that our interest rate is connected to the binomial, to the up and down tree in some way. But then the AK, BK are free parameters determined by the model, determined by outside factor. Okay, so let me explain. So, for example, right, we take the two-step binomial tree. You have R0, right, and then you have R1 and R2, right? And let's take the whole model. Okay, so wholly, right, says RK of omega is AK plus BK times UK of omega. So first of all, if I were to give you this as a problem to do, on the exam or on the homework, what do I need to give you? I need to give you what? I need to give you A0, B0, A1, B1, A2, B2. Is that okay? Because these are the parameters you need to populate the interest rate tree. Okay. Now, so again, right, let's backtrack a little bit, right? This is exactly like in the stock, right, binomial tree, I give you the U and D. But you understand, right, this U and D, I'm not God to give you this kind of things. I'll give you that to demonstrate the idea and for you to do the homework. But in real life, right, these are determined by what? By observing the market and deduce back on what are the most appropriate values for these guys. Okay, we'll talk about that. But for now, right, let's say you're given this and see how to populate the tree. Let's say, A0 is 0.05, A1 is 0.045, B1 is 0.01, A2 is 0.04, B2 is 0.01. All right, let's test your understanding here. What can you tell me what R0 is? And by the way, right, what's B0? Where's B0? Why don't I give you that? And what's R0? So you see, again, right, just follow the formula. R0 is A0 plus B0 times U0 of omega. No dealing. B0 doesn't have to be 0. But what's U0 of omega? Exactly. So B0 is irrelevant. That's more like it, right? U0 is 0 because there's nothing to talk about. That's why B0 is irrelevant. It's not like, so what's R0, right? .05, okay? Then so now R1, right, has two possibilities, R1U and R1D, right? What's R1U? .145. R1D 0.045. Am I right? R1UU, sorry, R2, right? UU would be, so A2 plus 2B2, right? So that would be 0.06. Oh, wait, hold on. I add things wrong, right? So it's not 0.045, 0.05, 0.145, 0.055, right? R2UU is 0.06. R2UD will be 0.05. And R2DD will be 0.04. Is that okay? So that's how you populate, right, this interest rate at these points. Okay. So now, what else do we need? So of course, like, right, I hope you can do the same thing with the black dermatoid, right? Again, I will have to give you AK, BK, and then you will populate the tree. So then the question is, right, what do we do with this? And how do we figure out these actual values in practice? But let's slow down, right? So what do we do with this, right? Maybe we need the probabilities of up and down. Like what I mean is this, right? What's the probability, risk neutral, let's say, of UU? Or what is this? Is that okay? For example, right? I mean, actually, this guy is the most important one because P of UU is going to be P tilde of U square, right? By independent, right? This and this are independent, so twice 2 step up is. So in other words, right, you know how this is important, right? For example, what's the probability, let's say, of R2 equals to 0.06? That's going to be whatever that quantity P tilde U is, square. Is that okay? But the question is, what is this guy? And then, of course, right, from there, we also will know what is this guy. But what is it? Does anyone know? So by the way, right, this AK, BK can change for each step, right? That's the calibration of the model. But the probability, right, should be fixed, right, for each step. You don't think of the tree as changing probability, as you move across time. All right. So, any guess? So before, right, we have something like this. Remember, Q is e to r delta t minus d over u minus d. Do we have anything like that here? So you have the right idea, but the idea there is for calibration, Dion, not for, right, meaning to figure out the AIs and BIs, not to figure out the probability. Because when you discount it, by the way, right, let's say if you have something in the future, right? Otherwise, if you have it right now, there's no point. But if you have it in the future and you discount, fine. But discount through what path? And so the whole point is, you see, you have to do a expectation. But if you do expectation, then you need a probability. You understand the point? So exactly, you're getting to pricing. And pricing, right, because we are imposing, right, a probabilistic model, we need probability, right? My question is, where does it come from? Right, before, remember how we make a big deal out of this guy cannot be arbitrary, right? Because of no arbitrage and all those good jazz, right? Now here, where can we find these values? So the answer actually will be a little bit anticlimactic. There's no determination for Q internally here. Or let me say, right, for P tilde U. No. Okay. And why? Do you remember the basis for us to derive this equation? What's the logic behind this equation? The logic behind this equation, right, is the pricing on the stock itself. Let's say it's the price of the future stock discounted must be the current stock. Exactly. Very good. But, right, do we have a pricing equation like that on the interest rate tree? Can we say something like this? Right? Exactly, Dylan, you got that. So is there something like that here? I don't know. Well, right. The reason why the future stock price must be the current stock price is because if you hold a one share of the stock today, right, by definition, it will grow to the future stock. Yes. So the future and present are connected like that. So in other words, right, this equation is because stock is traded on the market, right, as an actual thing you can hold. You see anyone trade interest rate out there? Can you buy, I don't know, one share of interest rate? Is interest rate a currency value? Exactly, right? It's a return itself. So this equation, there's no pricing on interest rate. It makes no sense, right? I mean, I guess it's kind of blunt when we put it that way. But right, when you're into the symbol, you don't recognize it. But interest rate itself is not a traded product. Remember once upon a time we say something like, a derivative based on, remember, a non-tradable product like temperature. Funny enough, right, interest rate is also a non-tradable product, okay? And cap and floor are actually derivatives on non-tradable product, okay? Because, right, no one trades interest rate. So therefore, right, remember one of the consequences of us saying that you have derivative on non-tradable product is the price is not uniquely determined because you don't know what Q is. Exactly the same thing here. So Q has to be given exogenously somewhere else. Like if you have a stock model somewhere together with this, then you may be able to decide the interest rate. But if you have the interest rate tree by itself, then there's no God-given rule that say this must be Q. So the Q is not unique, or whatever you want to say it. Okay, R is not a tradable product. So for that matter, you can throw every number in, right? That this number is determined somewhere else. Maybe your friend is modeling a interest rate tree, and he say, I must use this for my interest rate tree, stock tree, right? And I must use this probability. So you would use that, okay, here. So for that matter, we can just do this. And this number is completely arbitrary. They're not connected with the model parameters in any way. Is that okay? So let me recap, right? It's very important that in interest rate model, we automatically assume a risk neutral framework given. Okay. In other words, remember the stock that I made a big deal out of, like converting from the physical world to the risk neutral world and the relation between these two, all this kind of good stuff, right? Here, interest rate, no transition. The transition is done on the stock side because the stock is traded, okay? Interest rate is not traded. So unless you give me a risk neutral world that I can operate in, I don't know which world I should use. It says I cannot determine that by myself. Is that okay? Question. Okay, so now let's decide price. Okay, so uh, so what do I want, right? So I have the stock tree model, right? I want to say one thing. For discrete model, okay, let's use discrete compounding by convention. What we mean is this, that let's say from one period to another, let's say from k to k plus 1, okay? Let's say the length of the period is delta t. Then if I go forward, right, then if I start with 1, right, if I start with 1, or let me say, right, if I start with, yeah, L, whatever, the capital that I state, then I go to L times 1 plus R times delta t, okay, in the next period. And of course, right, if I end up with L, then I must start with L over, so the discount factors like that. And maybe let me do, right, R sub k, right, R sub k. Is that okay? I should do little r, right? So you understand, right? So two things, right? So first, discrete compounding, you need to know the length of period to work on, like 3 months, 3 months, right? So our conventions we always measure stuff by year. So 3 months means 1/4 of a year. Second, right? The interest rate always is determined at the beginning of the period. So RK, right? R2 is used for the period 2 to 3. So for that matter, right? If you look at this tree, it's kind of funny, but R0 is used for the period from 0 to 1. R1 is used for the period from 1 to 2. So even though we model R2, R2 is useless unless you want to talk about something going on at step 3, which is fine, right? Actually, so what is meant is that this tree is good to use for up to 3 period because R2 is used for the period 2, 3. Is that okay? So let's do that, right? So pricing, let's say we price the bond B03. Okay, what does that mean? B03 is expectation of, right? You get paid by 1, you discount, sorry, like that. That's your bond price. That's the price you get, right? That's the price you pay to receive $1 for sure at time 3, based on our tree model. Correct, always assumption, right? When we write this thing down, because you see, otherwise we just always have to carry another face value in front of it, right? Which is cumbersome. So 1 is always the face value by assumption. Okay. And you know how to carry this down, right? You know how to carry it out. How many you have to do what? You should do a a table, right? Where how many values do you have, right? UU, UD, right? I guess DU is and DD, right? And then you do, right, 1 plus R0 delta T, 1 plus R1 delta T, 1 plus R2 delta T, right? And then probability, and then you add them up, right? Let's show you, right? For example, let me make it easy for myself, right? Let me make delta T equals to 1. Okay, that's kind of weird, but okay, so 1 year, right? So what is my 1 plus R0 delta T? Remember, R0 is 0.05, right? So here it will be 1.05 throughout everything. Okay. My R1 is what? My R1 depends on U or D, right? The first U or D. R1U is 0.055, R1D is 0.045. So 1.055, 1.045, 1 point, sorry. Is that okay? Because, right, the first U here and the first D here. And finally, right, what about R2? 0.06, 0.05, and 0.04. So 1.06, 1.05, 1.06, 1.05. Probability, right? I think I say U is 1/3, so this is 1/9, 1/9. Sorry, 2/9, right? 2/9, 1/9. Is it okay? And so what do you do, right? Basically, then B03 will be 1 over, right? One of these guys times this probability times this probability times this probability atom. I'll just write once for you. Oh, did I do it wrong? Uh, R2 should be, oh, ah, sorry. Thank you. 1.06, 1.05, 1.05, 1.04. Yeah, just checking if you pay attention. All right, cool. Is this good? Yeah, Cool, right? So I made a mistake here, no? Or did I do it fine? This is okay, right? And then, am I okay with the table? You got it? Okay, appreciate it. All right, so using the same idea, right? How many bonds do we get out of this? How many bond price do we get out of this model? At time zero, right? Because this is the time that we know. How many bonds do we get out of this market, out of this model? 3, right? B01, B02, B03, right? Now, these, right, you understand, can be read off from the market, right? You can look at the bond price with 1 year in maturity, 2 year maturity, 3 years in maturity, right? And then how many unknown parameters do we have in the model? Right. So here, right, we take exactly the opposite point of view. If you want to, if you think that, right, the parameters are unknown and the product price is given in the market, then how many unknown parameters do we have in the model? For whole Lee, you have 5, right? Because B0 doesn't matter. So you have 5 unknown parameters. So for purpose of calibration, for example, right, for model calibration, we need 2 more. Since we have 5. Is that okay? So again, right, you see how interesting this is. That say for the stock model, you only have actually one unknown parameter, the unknown, the volatility, the implied volatility sigma. And you have so many call options to fit. And so the problem, usually you cannot fit all of them because you only have one parameter. With the interest rate, you have the opposite. You have a lot of freedom. But that don't worry, right? You also get a lot of product to begin with anyway. So usually there are way more products in the market than you can fit. But one feature of the interest rate model is it tends to give you more degree of freedom to fit the product, right? So for example, here one thing you can say is your model will price the bond price perfectly if you use it, if you choose the bond, if you choose the calibration for your interest rate, right? So what are the products that we can consider? We can consider cap and floor. Okay. So so let's describe the cap and floor, and we'll talk about the forward rate next time. Okay. Describe the cap and floor and try to price the cap and floor. So our interest rate tree, right, is 0, 1, and 2. Okay. So remember, right? So the play field is up to time 3 because the R2 is available for borrowing a lending, right, up to time period 3. So a cap, right? A cap with rate, sorry, with strike K, right? Okay. Makes a sequence of payment. Okay. Like this. It pays Rk minus 1 minus k plus times delta t at time k for whatever duration you want, for the duration of borrow or lend. Okay, what do we mean by this? And by the way, right, why k minus 1k? That's because, again, right, the convention is, right, the interest rate from the beginning of the period is the one that we use for the entire period. So let's say, right, let's suppose that the duration, right, of borrow or lending is exactly 0, 1, 2, 3, right? Suppose our duration, right, the period is from 0 to 3, okay? Or rather, yeah, 0 to 3, because it goes from there, right? So what happens is, right, you will receive the following. You will receive 3 payments if you hold a cap. If you hold a cap, you'll receive R0 minus K plus times delta T here. R1 minus K plus times delta T here. And you receive R2 minus K plus times delta T here. Is that okay? That's how the cap works. It's not one single payment, but it's a series of payment throughout the entire duration. And you understand why, right? That this series of payment, there's a series of payment, right, for the interest rate cap, right? Because basically, so a person, right, a series of payment is exactly, it's not to make your life harder, but that's just how things naturally work, right? Because, you know, at time 0, right, a person would have to lend or borrow at rate 0 for the time period 0 to 1, right? And suppose that the desired rate of that person is k. Then if R0 is above k, then that person has to, you know, I guess borrow, right? Whatever, pay more at this time, right? How much does she pay more? Exactly this amount. So, right, by time 1, she received this much, which compensate for exactly what they have to pay out of pocket. You know, I guess how to say this, right? Actually, they will have to pay this difference at time 1, but your payment, right, from the cap will exactly make up for that amount, right? So at time 1, that person will receive the cap payment, if any, right, to make up for the difference, to make up for the difference in investment. Is that okay? And then, right, which is exactly this amount. And then at time 1, sorry, and then that person will have to lend and borrow at rate R1. Then the story continues, right? The desired rate is K. So at time 2, they will again receive the cap payment, if any, to make up for that difference, and so on and so forth, right? Of course, if the period of investment, right, is from the duration, right? So of course, another variation on the cap is this. The duration of investment, sorry, right, doesn't have to be 0 to 3. You could have a duration of investment from 1 to 3. In other words, the person does not borrow or invest at time 0, right? Then when does the cap start to pay? The cap starts to pay at 2 and 3. Does that make sense? And if the duration, right, let's say, I don't know, is 2 to 3 or 1 to 2, then cap only makes one payment, right? At 3, and in this case, it's called a caplet. Is that okay? A caplet is a cap payment. It's a cap for a 1-period investment. So if you observe, then basically, right, this is not a big deal, but a cap, right, is a sum of the caplets over the period of investment, right? In other words, this cap for the duration of 0 to 3, right, can be broken down into caplet, right, for the period 0 to 1, plus the caplet for the period 1 to 2, plus the caplet for the period 2 to 3. Are we okay? So in some sense, right, this is like 3 call options on the interest rate, which start with maturity 1, maturity 2, maturity 3. Yeah, so exactly. Or you can say, right, basically, yeah, interest compounds at those times, but interest also change at those times, right, by our model. Interest updates at those times, right? And especially when you borrow at like LIBOR rate or something, or, at lock rate, right? You know how things work. You usually can lock in your rate for like 3 months. And then next, when it matures, right, you have to come back to the bank and check the new rate. Yeah. So that's just how things work, right? Usually you lock in the rate for the pure investment. Then for next time comes, you got a new rate, so on and so forth, right? So I think I think it's a good place to stop right here. We're gonna discuss the pricing, right, of these basically just call option, and then floor, right? Floor is similar to cap, forward rate. Say a few words about the continuous time interest rate model, and then that'll be it for our class, okay, this semester. So yeah, we'll continue next time. All right, we'll stop here today. Yeah. Yeah. So I think I know what you're talking about, right? B01 will be 1 over, right, 1 plus R0 delta T. So B01 doesn't have, B01 actually is deterministic, right? Why so? Because you think of how the interest rate works, right? You know the interest rate right now. So exactly, you know, for that period going forward, how much you're borrowing or lending. So for that matter, even though one seems to be in the future, right, B01 is the peculiar guy where, right, is exactly deterministically known by now with the R0, right? Because of that kind of now working for the next period, that kind of logic. Okay. You too.